The global financial markets experienced a significant downturn on Monday, reminiscent of the infamous Black Monday of 1987. This was triggered by growing concerns that the United States might be heading towards a recession. The catalyst for this market turmoil was the release of disappointing U.S. employment data, which showed that job creation had fallen sharply below analysts' expectations. This unexpected slowdown in the U.S. economy has caused widespread anxiety among investors, leading to a sell-off in stock markets around the world. What initially seemed like a domestic issue quickly escalated into a global crisis, as fears of a U.S. recession prompted investors to reassess their strategies and seek safer investment options. The mass withdrawal of capital from riskier assets led to significant declines in stock indices worldwide, including a particularly sharp drop in Japan's Nikkei, which recorded its worst performance since 1987. The negative sentiment was further fueled by rising geopolitical tensions in the Middle East, following the assassination of Hamas leader Ismail Haniyeh in Tehran, which has sparked concerns about potential retaliations. Adding to the uncertainty, Japan's central bank decided to raise interest rates to combat inflation, a move that disrupted long-standing market positions that had benefited from the country's previously low rates. This shift in Japan's monetary policy, coupled with the already tense market environment, exacerbated the situation, causing further declines in global markets. As a result, investors across developed and emerging markets are now grappling with a complex and unstable financial landscape. The recent U.S. payroll report had a significant impact on the financial markets, as it revealed that only 114,000 non-farm jobs were created in July, far below the 175,000 jobs that financial analysts had anticipated. This disappointing figure included just 97,000 jobs added by the private sector, marking the second lowest number since December 2020. Consequently, the unemployment rate rose to 4.3% from 4.1%, signaling a more abrupt slowdown in the U.S. economy than expected. These labor market figures were released just 2 days after the Federal Reserve decided to keep its interest rates unchanged for at least another 45 days. Currently, the federal funds rate stands at a range between 5.25% and 5.5%, the highest level in 21 years. High interest rates make borrowing more expensive for both consumers and businesses, which can dampen economic activity and reduce consumer spending, potentially leading to a recession. Despite this risk, the Fed has been hesitant to lower rates, aiming instead to bring inflation back to its 2% target. With inflation currently at 3% over the past 12 months, there were concerns that a robust labor market could drive prices even higher. However, with the latest jobs report, investors are increasingly worried that the Fed's strategy to curb inflation without triggering a recession might not be succeeding. As Helena Veronese, the chief economist at B.Side, noted, the market has swiftly shifted from concerns about when the Fed might start cutting rates to fears about an impending recession. This shift in sentiment has led to a reassessment of the likelihood of future rate cuts and the overall health of the economy. A potential recession in the United States carries significant implications for the financial markets. The most immediate effect of such a downturn is a reduction in corporate profits, as economic activity slows and consumer spending declines. This leads to lower earnings for companies, which, in turn, causes their stock prices to drop as investors anticipate weaker financial performance. Beyond the direct impact on profits, a recession creates broader economic challenges. With reduced revenue expectations, companies tend to cut back on investments, struggle to meet debt obligations, and may even resort to layoffs or bankruptcy. This uncertainty and instability make investors more cautious, leading them to pull back from riskier assets in favor of safer investments. As investors shift their money away from stocks and direct investments, they often turn to U.S. Treasury bonds, which are seen as one of the safest assets available. Given the size and influence of the U.S. economy, this shift in capital has global repercussions. Stock markets in other countries may also experience declines, and the U.S. dollar typically strengthens as demand for these secure assets increases, reflecting the widespread impact of a potential U.S. recession on the global financial landscape. U.S. stock markets experienced significant declines, with major indices dropping around 3%. The Dow Jones Industrial Average fell by 2.6%, the S&P 500 dropped by 3%, and the Nasdaq indices also saw sharp declines, with the Nasdaq 100 down by 2.96% and the broader Nasdaq Composite falling by 3.43%. This widespread sell-off affected most of the companies listed on the U.S. exchanges, reflecting a broad-based market downturn. In recent months, U.S. markets had been buoyed by strong performances from technology stocks, but this momentum has faded following disappointing corporate earnings reports. Investors were particularly let down by companies like Amazon, Microsoft, and Intel, which failed to meet expectations despite their large market capitalizations. Additional concerns were raised by news that Warren Buffett had sold half of his stake in Apple, along with the sharp 25% decline in Intel's stock last week. The high valuations of companies involved in artificial intelligence also contributed to the market's anxiety. The decline in U.S. markets was not isolated, as European markets also experienced significant losses. The STXX Europe 600 index, which tracks 600 companies across 17 European countries, dropped by more than 3%. This reflects the global nature of the market volatility, with both U.S. and European investors reacting to the same underlying concerns and uncertainties. Tensions in the Middle East have escalated significantly over the past week, adding another layer of stress to the financial markets. The situation became particularly volatile following the funeral of Ismail Haniyeh, a leader of Hamas who was killed in Iran's capital. This event sparked protests and calls for retaliation against Israel, with Iran and Hamas both accusing Israel of carrying out the assassination. Although the Israeli government has neither confirmed nor denied responsibility, the incident has fueled fears of further conflict. Iran's supreme leader, Ayatollah Khamenei, vowed severe punishment for Israel, while Iran's new president, Masoud Pezeshkian, condemned the killing and emphasized Iran's commitment to defending its territorial integrity. He warned that Israel would regret this cowardly assassination. Meanwhile, Israel's defense minister, Yoav Gallant, stated that while Israel does not seek war, it is prepared for any scenario. This rhetoric has heightened concerns about a potential military escalation in the region. Conflicts like these generally have a negative impact on economic activities and can exacerbate market volatility. According to Helena Veronese from B.Side, if a war involving Israel were to break out, it could have inflationary consequences, potentially altering interest rate expectations. However, the overall sentiment remains one of heightened risk aversion, which had already been elevated due to other global economic concerns.